SoFi just released their latest quarterly figures. Now, Q4, a good quarter. The problem was guidance. There are other problems as well with regards to non-recurring stuff, which impacted net income positively. There are also some changes with regards to taxes, which will impact EPS negatively. Now, I was also listening already to the earnings call, so I can already provide you with some crucial answers. Now, when they released their earnings report, the stock went down 15%. Of course, the overall market was down quite a lot as well. It doesn't help. But right now, we are only down 8.7% at the time of making this video because of a specific comment that was mentioned during that earnings call. So let's discuss all of that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first up, let's start with my predictions and results. What's in red is, well, worse than expected. What's in light blue turquoise is better than expected. So Q4 new added members were 785,000, lower than my expectations of 795,000. And so the CAC here is also a bit higher than that, $292. Galileo Q4 revenue, our tech platform, not that great, $102.8 million. That continues to be, well, the struggling piece of SoFi. Now, Q4 adjusted revenue, much higher than what I expected, $739 million with adjusted EBITDA of $198 million, which is $10 million higher than what I predicted. And EPS, 5 cents, came in line. And so this is basically the major overview for the quarter and then, well, for the year ending 24-23. Now, the important part here is, we're going to talk about guidance later on, but this comment right here is what made the stock rebound a little bit. 2026 EPS of 55 to 80 cents guidance was reaffirmed, and EPS target nearly 40% ahead of consensus for 2026. And it's not just the 2026 EPS guidance, it's also what's coming after that, the continued 20 to 25% growth. So that's great. Why is that great? Well, because you're going to see that the guidance numbers were not that great at all. But there's a reason for that. Now, looking at net income, you've probably seen the huge increase here year over year. There is a reason for that as well. That's when we adjust for non-recurrent benefits related to deferred taxes. Adjusted net income reached $61 million. So, of course, a huge difference between the $332.5 million. Then a couple of comments here from Anthony Noto. 2024 was SoFi's best year ever. Our ability to deliver durable growth and strong results throughout the year was once again the direct result of our relentless focus on innovation and brand building. SoFi set new records in revenue, profit, members, and products in 2024, and we look forward to continuing to build momentum on this in 2025. In the fourth quarter, our financial services and tech platform segments made up a record 49% of SoFi adjusted net revenue, up from 40% in the year-ago quarter. These businesses grew revenue by a combined 52% year over year, a testament to our continued execution and deliberate shift towards capital-light, high ROE, cash, fee-based revenue streams. And well, the big contribution to that 52% year-over-year growth is financial services. Now, with regards to the fee-based stuff, first of all, the CEO also announced a $5 billion loan platform business contract during the call, so that's great. They also said the following. For the fourth quarter of 2024, total fee-based revenue of $289.5 million increased 63% year over year. For full year, fee-based revenue was, well, just under $1 billion already, increasing 74% year over year. This was driven by strong performance across originations fees, loan platform business, as well as interchange, brokerage, and referrals. In the fourth quarter, they generated $63.2 million in loan platform fees, driven by $1.1 billion of personal loans originated on behalf of third parties, as well as referrals. Additionally, their loan platform business generated $3.6 million in servicing cash flow, which is recorded in their lending segment. In total, the loan platform business added $66.9 million to their consolidated adjusted net revenue across these two segments. And so in the full year of 2024, their loan platform business originated and transferred a record $2.1 billion of personal loan volume, and that's still growing at a super rapid pace. And so overall, this is basically it. When you look at 2024 compared to 2023, members and products, members grew 34% year over year. They added 2.8 million members. Remember that number. Product-wise, they increased that by 32%. Now, of course, we talked a little bit about, is crypto going to come back? Let's wait and see. Let's wait and see what happens. As for the tech platform that has increased, we've seen a reacceleration in growth compared to 2023. It grew 15% year over year. Technology platform accounts ended 2024 at 168 million. Now, it's still that side of the business that really needs to grow much quicker. They did announce that they signed a large US-based financial services provider that offers short-term consumer loans, card services, check cashing, and other financial products. They have a large, loyal, and highly active debit card portfolio and will rely on our technology to power existing and new capabilities. Once they fully transition to our platform in early 2026, they will be a top 10 client on a revenue basis. Not that huge, let's be honest. Now, the implementation and the integration cycles will be gradual, and the revenue impacts will most likely be in 2026. So, good to know. But 2025 is not really when we are going to see the huge impacts of these things. As for the financial services and tech platform revenue, that continues to grow extremely quickly, and it's also taking a bigger chunk of the revenue mix. Looking at contribution profit for each of the segments, so lending, tech platform, and financial services, lending continues to go up quite nicely, even quarter over quarter. Tech platform, of course, is down a little bit because, well, total net revenue hasn't really moved that much. So again, this remains the AWS of fintech. Well, tech platform right now remains a big disappointment, at least in my eyes. But financial services, still growing quite rapidly. Contribution profit is up very much year over year and quarter over quarter up nicely as well. And so overall, we have adjusted net revenue that increased 26% year over year, adjusted EBITDA at $666 million. That's a horrible number, but the adjusted EBITDA margin sits at 26%. And well, 2024 was the first full year of profitability, 15 cents, with an adjusted income margin of 9%. And now the big problem is, of course, well, the big problem. Yeah, I would call it a big problem. That's when a lot of people had questions. That's full year and Q1 2025 guidance. Again, they reiterated 20 to 25% EPS compounding expectations beyond 2026. It's very, very important that they reiterated that on the call, because if we look at fiscal year 25 guidance, diluted earnings per share, 25 to 27 cents, that's not great. That's not great, even compared to what the analysts are expecting. That's really not great. Now you might say, oh, but this is classic SoFi, right? Starting the year with the bar quite low. Well, yes, maybe. But if you look at revenue is still expected to grow, what? Let's take the 26% at the high end, which is much more than what the analysts are expecting, and yet diluted earnings per share is lower than what we expected. Well, they said that as they look forward to 2025, after a year of bolstering the capital base, reaching GAAP profitability, as well as the scale required to drive continued profitability, management wants to better tilt the incremental revenue growth toward investment. So, okay, we know EPS going to get hit because they want to invest more. But then there are two extra things I want to add here. One, if that's the case, then member growth should have been more than what has happened in 2024, right? Because this is about the same number. Well, they say at least 2.8, so it's going to beat the number for 2024. So you invest, yet you don't see more, incremental growth when it comes to member growth. That's a bit strange. Now, their assumptions are, again, quite bearish. GDP expansion of just 1.2%, normalization of unemployment in the 5% range, and then interest rates outlook consistent with the forward curve and just north of 1.5 rate cuts. Now, remember what I said yesterday in the Tom Lee portfolio review video? The longer the rate cut cycle, lasts, the better for a bull market, Because if we have, let's say, all of the cuts in 2025, then what happens in 2026? There won't be any, let's call them macro catalyst. But if you barely cut in 2025 and then continue to cut in 26 and then maybe even cut in 27, then you just stretch that rate cut cycle more and more, which is usually quite good for a bull market. Now, I do want to add here an extra thing, because as we've seen with net income, there was a tax benefit from the deferred taxes. Now, the interesting is that SoFi has exhausted its tax loss carry forwards, meaning future earnings will now be subject to federal and state taxes, impacting EPS, which is why we are seeing this number here lower than expected. The estimated combined tax rate for SoFi is, well, I think they said it's around 25-26% or so, which, well, will reduce EPS by about 9 cents. So, okay, when you exclude that, then the number does make sense, because EPS is going to be higher than what the market was expecting and what we were expecting as well, so it makes sense. Now, paying taxes also allows SoFi to benefit from tax deductions on expenses, which is probably why they are focused a lot more on investing in 2025. Now, if we put all of the puzzle pieces together, it makes sense. An overreaction by the market, if we open up minus 10% or more, I'll be a happy dip buyer, because, again, did something change from that 2026 guidance? No, not at all. An overreaction, not just for SoFi, the overall market with DeepSeek and all of that. Plus, big deal, right? Where are we at right now? A price not seen since what? Last week, 10 days ago? Big deal, right? Big deal. I've heard what I needed to hear. I had some questions, but then in the earnings call, they did answer most of the question. The tech platform is still a little disappointing, but oh well. So overall, that's about it. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.